For over 50 years, central banks did not buy silver, not a single ounce. They sold it. They melted it. They removed it from their vaults and replaced it with gold and government bonds. Silver was declared a relic, an industrial commodity, something factories needed, not treasuries. That 50-year rule just broke. And the implications of what is happening right now in the world's central bank vaults is something that most retail investors will not understand until silver has already moved to a price that makes today look like the opportunity of a lifetime. Today, I'm going to show you exactly which central banks are buying silver, why they are doing it now after 50 years of absence, what they know that most investors do not, and why what is happening behind the closed doors of sovereign wealth funds and central bank treasuries right now is the most important signal in the silver market. Let us start with the history that makes this so significant. The relationship between central banks and silver has been one of abandonment for over half a century. Following the crime of 1873, when the U.S. demonetized silver, and the final exit of silver from the monetary system after Nixon ended the Bretton Woods Agreement in 1971, central banks systematically eliminated silver from their reserves. The U.S. strategic silver stockpile established in 1968 with 165 million ounces was completely depleted by 2002. For at least 20 years, no major central bank held meaningful silver reserves. The vaults that once held billions of ounces of sovereign silver were empty. Then in 2024, something happened that had not happened in living memory. Russia moved first. Under Western sanctions that had frozen Russian gold reserves and blocked dollar-denominated transactions, the Russian central banks started searching for assets that could withstand U.S. financial coercion. Gold was the obvious choice, but Russia already owns large gold reserves, and further buying would draw intense scrutiny. Silver, by contrast, was being rediscovered for its strategic value: hard industrial demand from energy transition, defense electronics, and semiconductors. Monetary characteristics including scarcity and resistance to debasement. And critically, a price low enough that Russia could accumulate significant quantities without immediately signaling its intentions to Western intelligence. The Russian state fund included silver in its 2025 to 2027 acquisition program, the first explicit central bank silver purchase announcement in modern history. The allocation was $535 million over 3 years. That sounds modest until you understand what it signals. Russia is not buying silver because it needs $535 million worth of metal. Russia is buying silver because it is establishing a precedent, a policy framework, a template that other central banks can follow, and they are following it. India has acquired more than 900 million ounces of silver through government purchases, corporate stockpiling, and household investment over the past 5 years, exceeding reported LBMA holdings over the same period. India's approach is less formal than Russia's, but the scale is extraordinary. Nearly 1 billion ounces quietly accumulated by a country with 1.4 billion people that is simultaneously building the world's fastest growing solar energy infrastructure. Every solar panel India installs requires silver. Every electric vehicle rolling off Indian production lines requires silver. The government is not just buying silver as a monetary reserve, it is securing strategic industrial supply. But here is the layer of this story that Western media finds hardest to track. Some emerging market central banks have started shadow buying, acquiring silver via third-party entities, sovereign funds, and non-transparent channels, rather than through formally announced reserve programs. The advantage is obvious. They avoid headlines while quietly building strategic stockpiles. Rough estimates suggest that from the second half of 2025 into early 2026, emerging market central banks may have acquired several 100 million ounces of silver through these shadow routes. This is not confirmed data. It is estimated from trading flows, vault movements, and shipping patterns. But the circumstantial evidence is compelling. Here is why central banks are making this move now, and why the timing is not accidental. A central question in the global de-dollarization push is, how do you settle international trade without using the dollar? Gold is an obvious candidate, but it is very expensive. Not every country can realistically settle large volumes of trade in gold. Silver, however, is much cheaper per unit and simultaneously has real industrial demand, meaning it cannot be fully virtualized or replaced by pure digital tokens. Silver is the perfect bridge between monetary metal and industrial commodity for nations trying to reduce dollar dependence. And the geopolitical context has made this more urgent than at any point since 1971. Russia's frozen gold reserves demonstrated to every central bank in the world that assets held in Western custody or denominated in Western currencies can be seized, confiscated, made inaccessible. The lesson was stark. If your reserves are in U.S. treasuries or London vaults, they are only yours until Washington decides they are not. Physical silver held in domestic vaults like physical gold cannot be frozen by a swift message or a U.S. Treasury order. This is the fundamental motivation driving what Sprott's John Ciampaglia described as a broader structural shift that will unfold over several years. Central banks are recycling dollars into physical assets. They are reducing exposure to U.S. treasuries. And as they search for physical assets that combine monetary characteristics with industrial demand and accessible price points, silver is increasingly appearing on their lists alongside gold. Poland's central bank approved a plan to add up to 150 tons to its gold reserves. China's central bank increased gold holdings for 14 consecutive months through December 2025. Turkey, Singapore, India, Saudi Arabia. The list of central banks diversifying into physical assets is long and growing. And TradingKey confirmed what most Western analysts are still reluctant to say directly. Silver is quietly breaking away from paper markets as AI, nuclear power, and central banks all start fighting for the same limited pile of real metal. Now, let us understand what happens to price when central banks enter a market. When central banks buy gold, they do not trade. They accumulate, slowly, consistently, over years. They do not panic buy on price spikes. They do not panic sell on price drops. They accumulate at whatever price is available because their objective is not profit. Their objective is strategic reserve building. This means central bank buying creates persistent structural demand that does not respond to normal price signals. It is demand that exists at $80 silver and at $150 silver. It is demand that does not disappear when the Fed turns hawkish or when speculators exit. It is the most durable form of demand in any market. CME Group's precious metals outlook confirmed that official sector activity has transitioned from sporadic purchasing to a trend of consistent accumulation. The near majority, 95% of central bank officials surveyed, expected global central bank gold reserves to increase in the next 12 months. Because these purchases are often strategic and longer-term in nature, they contribute to a more diversified market structure. The persistent presence of these institutional holders adds depth to the overall marketplace, distinct from the patterns often seen in short-term trading flows. Silver has no such backstop yet. As Forex.com noted directly, unlike gold, silver has no central bank backstop. Now, there's no lender of last resort when inventories run thin. That makes price move sharper, faster, and far more explosive. But here's the critical insight. The absence of a central bank backstop is precisely what makes the first few central banks to enter so powerful. They are not joining a crowded trade. They are pioneering an uncrowded one. The 5 consecutive years of supply deficit, the 820 million ounce cumulative gap between supply and demand, the COMEX inventory drain, the Chinese export controls. These are the fundamental drivers that exist independently of central bank activity. Add central bank accumulation on top of a market that is already in structural deficit, and the supply equation becomes genuinely alarming. The Silver Institute has confirmed that industrial demand hit record levels of 680.5 million ounces in 2024, while COMEX inventories plunged to 15-year lows. Mine supply has been flat for years, and now a new category of buyer, the most persistent and price-insensitive buyer in any market, is quietly entering a supply-constrained market and building positions that will not be sold regardless of price. Here is the most important thing to understand about what is coming. When central banks entered gold aggressively starting in 2010, gold was trading around $200 per ounce. By the time their buying became widely reported and understood by retail investors, gold was at $2,000. By the time it became consensus narrative, gold was at $3,000. The central banks that entered first captured the entire move. The retail investors who waited for confirmation captured a fraction of it. Russia's silver announcement in 2024 was the equivalent of the first central bank gold purchases in 2010. It was the signal, not the confirmation. The confirmation will come when 3, 5, 10 central banks have announced silver reserve programs. At that point, silver will not be at $79, and the investors asking whether they should buy will have already missed the structural setup that existed in March 2026. Silver at $79 today, with one central bank in, several 100 million ounces of shadow buying estimated, and de-dollarization pressure building across the emerging market world, is a setup that has never existed before in the modern history of this metal. The 50-year rule that said central banks do not buy silver is breaking, and when it breaks completely, the market that has been pricing silver as purely industrial will need to reprice it as something far more significant. Something big is coming, and the central banks already know what it is. Subscribe and drop your comment below. Which country do you think will be the next central bank to announce a formal silver reserve program? And what does silver look like when 5 sovereign nations are competing for the same shrinking supply?